Hey everybody, Trader Dave here, and I wanted to welcome you to this Invest Signals session on ETFs. This is our mandatory disclaimer required by us, by the regulators. Make sure you're familiar with that. For more information, you can go to our website at www.investsignals.com. And what exactly is an ETF? ETF stands for Exchange Traded Fund. And an ETF is made of securities like stocks, and when it's put together, it forms kind of like a basket or a composite representation of an underlying index. The purpose of this basket or this composite ETF is to try and duplicate the price movement and total return of the underlying index. A great thing about ETFs as well is that they trade on exchanges like a stock does, so that there's liquidity and an open market for that. So an ETF also gives you the ability to buy one security versus many securities to represent the movement of an index. So for example, the SPY is the SPDR ETF for the S&P 500 index. Now you can buy one share of the SPY, and that tracks the movement and return of the S&P 500 index, or you could go out and purchase different amount of shares of each weighted company in the S&P 500, because every company is weighted differently in the S&P 500, and make 500 separate purchases, which would only make your broker happy. Another example is GLD, and GLD is an ETF that seeks to replicate the performance of gold. So this allows you to purchase the ETF GLD without the need to purchase physical gold or playing the gold market through the very volatile and highly leveraged commodities market. ETFs also allow you to do proxy ETF trading, so it allows you to purchase an ETF that seeks to perform the same as an underlying index when you can't go out and purchase the index itself. So for example, the XOI is the New York Stock Exchange ARCA Oil and Gas Index. It used to be called the Amex Oil Index. But you can't call your broker up and say you want to buy 100 shares of it. It just doesn't trade as a security. But you could actually go out and find an ETF such as DIG or DUG and purchase the oil and gas index that way. Depending upon if you're bullish or bearish, you would either buy the DIG if you're bullish, or you would buy the DUG if you were bearish. So ETFs give you a lot of flexibility in that regard. So why ETFs in general? ETFs have intraday liquidity, which means that you can buy or sell them when the financial markets are open. Again, they are traded on exchanges like a stock, versus like an open-ended mutual fund, which is usually priced once per day after the market's closed. ETFs also have mass appeal to all types of investor. It doesn't matter if you're a short-term trader or you're a long-term investor looking to diversify your portfolio. ETFs also allow you to do things now that individual investors couldn't do in the past, which is to buy an index or to hedge with an index in your portfolio, which was a common technique used by institutions. And one thing that I like about ETFs a lot is that they have lower expenses than most managed mutual funds, so that you're not going to get a lot of cost slippage based upon expenses. Another great thing about ETFs is that they have a very low portfolio turnover, which means that taxable capital gains is more limited, giving you a tax advantage. But make sure you're always talking to your tax advisor in regards to those types of situations. So the first strategy we're looking to do is to trade a single ETF that covers different sectors. So initially, this is our market lineup for ETF proxies. So we're looking at trading around the S&P 500, the Power Shares QQQs, which tracks the NASDAQ 100, the SPDR Dow Jones Industrial Average, which tracks the Dow Jones Industrial Average 30, the Russell 2000, which covers the mid-cap stocks, the oil index, the banking index in the financial sectors, the real estate index, and the gold market. And the basis of this strategy is to just go out and purchase shares or short shares of the particular ETF that proxies for that particular index. So what's the weight of your ETF, and what does that mean? Exchange-traded funds can be priced differently depending upon the fund company that manages them. There are really three main ways to price a mutual fund on the ETF side. The first is price-weighted, and this is where the index trading price is based on the trading price of the securities that make up that particular component index. So for example, stocks with higher prices in the index or the basket of stocks in that ETF will have more of an impact on the movement of the index than stocks that have lower prices, because they're weighted by price. So a stock that is priced at $100 per share will have 10 times the influence in that index than a stock that is at $10 a share. The second is value weighted, and the influence on the security in the index is really based upon market capitalization. which is measured by the stock price multiplied the outstanding shares. So Google has a market capitalization of 350 billion or so at the time of this recording. Apple's got over 400 billion, etc. But in this example, let's say FGH Corp has 10 million outstanding shares and is trading at a $10 per share. That gives it a market capitalization of $100 million. And then you have another stock called XYZ, and that's trading at $50 a share, and it only has 1 million outstanding shares. That has a market weight of 50 million. Then if the composite of all the securities is 1 billion in the whole ETF, then FGH would have a 10% price influence and XYZ have 5% price influence. Even though the share difference for the 100 million is cap is $10 per share, and the 50 million is $50 per share. The third weighting mechanism is called unweighted, and this is where all securities, regardless of share price or number of outstanding shares, the volume, etc., are weighted equally. So if you have 4 securities in the composite ETF that are in equal dollar amounts, and they happen to be up 2%, 5%, 10%, and 13% respectively, then theoretically the shares should be up about 7.5%. So that's those percentages divided by 4. It's a very simplistic way of looking at it. They may be priced a little bit differently than that simple mechanism, but it's just a way of reflecting that price and market cap doesn't really matter. And if you have 4 shares in your ETF, which they have a lot more shares than that, then you would just do simple math to get your return. So at Invest Signals, we focus on whichever ETF is going to make us the most money based upon the expected move. So we might invest in different funds that have different pricing mechanisms. To us, it doesn't really matter. We're looking at expected return. Now, here's a really simple way to at least look at the top 10 holdings for an ETF. So in this example, we went to finance.yahoo.com and typed in IYR for the symbol. This is the iShares U.S. Real Estate Index, which tracks the real estate market. And as you can see, it shows the top 10 holdings for this ETF, which equal 37.21% of the total assets. So you can see that they're overweighted on these top 10 companies. It makes up over a third of the ETF. And you can see over in the percent of assets column which funds hold the most positions in their portfolio. So in this example, at the time of this recording, Simon Property Group Incorporated makes up 7.85% of that fund. So you can see that if something was going to happen with Simon Property Group, or if something happened with this top 10, it's going to have an influence on the overall direction of the ETF. Now, if you wanted to get even more in-depth on the number of holdings that a mutual fund or an ETF is holding, you can go onto their website specifically, and this is the iShares website, which is managed by BlackRock Securities. And this is an actual look of the overall. It's a very small portion of the list of the overall assets in the portfolio. But if you want to see what makes up the whole ETF, they have to disclose that information on a regular basis. So go to that website if you're interested in the iShares, and then there are other mutual funds and ETFs out there that do this as well. Leveraged ETFs are a little bit different than regular ETFs. They are in 2X and 3X varieties called doubles and triples. Now, they use a different investment strategy. What they have to do to get a 2 times return of the index or a 3 times return of the index is that not only would they have to purchase stocks, but they also have to use hedging techniques such as investing in futures and highly leveraged options and derivatives. And the price of those ETFs is actually reset daily. So if an ETF was to go up 10%, it doesn't necessarily mean that the leveraged ETF, the 2X or the 3X, would go up 20% or 30% necessarily. Now, the goal of a leveraged ETF is pretty simple. So on the 2X ETF, there's a bull and a bear ETF. Obviously, if you're a bull, you want the underlying security to go up. And a 2X ETF for a bull fund, you're expecting almost double return of the underlying index. If you're a bear, then you would expect double the inverse of the underlying ETF. So for example, if the S&P 500 goes up 1%, the 2X bull would be theoretically up 2%, and the 2X bear would be down 2% in theory. The 3X ETFs are the same as the 2X, except for the theoretical return is up 3% for the bull and -3 for the inverse ETFs for a 1% index move respectively. So what we do is a little bit different in regards to how we analyze the ETFs and if we should be in a 2X or a 3X ETF. So we actually look at all the securities that make up the individual ETF. Then we look at the influence that each stock within the ETF has on the overall performance of the exchange-traded fund. So we're actually looking at over 600 plus stocks at any given time, trade by trade if needed during the day. We use multiple time frame trend analysis, so we look at the long-term trend, intermediate term, and short-term trend indications on what directions we should be trading in. Then we look at additional entry points to ride our profits higher, or we can add to our existing positions from our short and intermediate term indicators. So why does our system work? Well, we actually look at several key metrics. We look at price action, we look at volume going into and out of the security, the ETF, the stocks, and the options. We look at the momentum of the overall market, the overall ETF, the sectors. We look at divergences. We also take a look and see where the big money's going and where the big bets are being made. And we also have some proprietary indicators that we use to measure some of these key metrics as well. One thing that we always employ is the trend is not only our friend, it is our best friend. We do not counter trend trade. That's like swimming against a very strong current, and we just don't want to do that. The smart money knows which way the market's going, and we want to make sure that we're going with that smart money. We also limit losses when we have one. It's okay to miss. You just don't want to take a 50% loss. So we'll take a 3% loss, a 5% loss. That's okay. There's nothing wrong with losing. Nobody is 100%, and there is no holy grail. We also buy when the pros are buying, and we sell when the pros are selling, so that we're going with the smart money. Also, members get exclusive training on these key topics to become successful investors and traders themselves. And the members get access to us with our members-only email address. Also, our analysis never stops. During the trading day and up to the end of the trading session, like in the case of the S&P 500 or the SPY, we know how many of the 500 stocks are being accumulated and how many are being sold off during the day. We then look at the particular influence each stock has as a weight in the ETF to see if there is more movement to one weighted side over the other. We know where the smart money is going and we trade with it. We also find sound fundamental companies that are undervalued and ready to move. So what does this actually look like on a graph? So the results showing us the money, the equity curve for the SPY alone since 1995. So this is if you took all the signals and you started with a $10,000 investment. Over the last, 18, 19 years, you would have turned that $10,000 into almost $160,000 just by trading those very few signals. So let's wrap this session up. So ETFs are baskets of securities that make up one particular security that represents an underlying index or a sector. ETFs offer the simplicity of purchasing just one security versus the whole basket of securities. ETFs can either be long if you're bullish, the underlying sector, or short against it if you're bearish against a sector. ETFs are weighted differently. We went through the 3 different mechanisms on how ETFs can be priced. Leveraged ETFs provide additional flexibility for those who are convicted one way or another if they're bearish or bullish, for higher returns, for a little bit additional risk. And having a great system makes all the difference in the world as far as profitability. To learn more about trading ETFs, please go to our website at www.investsignals.com. And don't forget about our $1 trial where we take all the risk. This is Trader Dave. Thanks for the time.